Welcome to Lykken on Lending, the podcast that dives deep into the heart of the mortgage industry. Your host, David Lykken, bringing you the latest insights, trends, and updates from the world of mortgages. Whether you're a seasoned industry veteran or just getting started, this show is your go-to source for all things mortgage. Let's get started. This is Lykken on Lending. Now your host, David Lykken.
Folks, we caught up with Coby Hakalir, who is with T360, really an interesting company. You're going to hear about that more. And there's probably a lot more I'll be telling you more about T360. They focus more on the real estate side and that they work with, and Coby's responsibility at T360 is to create a connection into the mortgage world. So he is a bridge into the mortgage space from T360, which again is primarily focused on the real estate side of the industry. He also is doing a great job with my good friend Greg Shear and Christy and Aaron D on creating some great podcast content. My staff been listening to him, and I said, we need to get him on the podcast. So big shout out to my producer, Ben Dela Cruz, who recognized that. And I was just thrilled to meet Coby, knowledgeable, articulate. I think you're going to enjoy this interview. He is a Senior Vice President, Managing Director of Mortgage Banking and Core Services at T360, and one of the more respected advisory firms in the industry. If you haven't seen the T360 data, be sure to check it out. I'm getting more and more into data, so check it out. And also, we'll put in the show notes the podcast he is a part of and producing each and every week, again, with some good friends of mine. I think you'll enjoy it. Coby, good to have you with me. I appreciate you joining me. You are quite a podcaster yourself. You, my good buddy Greg, you called me just recently, and you're doing a lot with communication. You've got a great perspective, and I'm really interested in you sharing your perspective, and then generally what's going on out there from your perspective. So how did you get into podcasting? How did that start?
That's a big question right off the bat, David. First of all, big honor to be here, to be asked to do this show with you. I've been following you for a long time. The whole industry follows you, so I'm no different. And just really excited to do this show and spend some time with you and, hear your perspectives too. How did I get into podcasting? That's a great question. It was about, I want to say 2 years ago that I was looking to have a little bit of a different influence on the industry and try something new. And I started posting on LinkedIn, and I started posting daily and just kind of speaking my mind. And I would find, every day there's topics, and we all read the news, or most of us read the news. And every day I would find topics, and as I'm reading, I'm formulating an opinion. And sometimes I'm disagreeing with, the journalist, or sometimes I'm disagreeing with the person in the story. And I was like, you know what? Maybe somebody out there, certainly not my children, but somebody out there wants to hear my opinion on something. And so I started posting on LinkedIn. And as I did that, my audience grew. And then I started getting asked to be a guest on podcasts. And then I started getting asked to be a host on podcasts. So that's the journey. 2 years in, I'm still learning. I'm still observing others and figuring out how to do it well, how to do it the right way. I recently got a really good microphone that I'm very excited about and proud of. It's the best one I've had so far. But, aside from that, we know the technology only goes so far. It's really the research you do.
Yeah, we geek out on equipment, and it's one of those things. I'm always looking for what's the best and what works and all that. But
your journey into mortgage lending, let's cover a little of that. We have a lot of people that are looking at getting into our industry. So how did you get in?
My mama made me.
Your mama made?
My mama made me do it. She got into this business. She was a stay-at-home mom for a while. And I think once my brother got to 4 or 5 years old, maybe 6, he was in school every day, and she decided she didn't want to stay at home anymore. Somehow she wound up with a job as a mortgage broker in Brooklyn, New York. She was very excited about it, and she's now 40 years into her career. Yeah.
So I love that.
Yeah, still doing it really well too. She's a $20 million a year producer and doing it just kind of on her terms and her time. And she's now doing people's grandkids loans of clients that she worked with many years ago. And at a certain point, she was a few years into the business. And instead of going straight home from school, there were days where I would go to her office and I would help her, package up FHA loans to be sent to Atlanta in the Regional Underwriting Center. And I didn't know what I was looking at, but I knew the order it was supposed to go in because she told me. So I knew what was supposed to go where, but I had no idea what I was doing. So it made me about the same as most loan officers. So and then 6 weeks later, you would get an underwriting decision. And so I was helping her close loans back in 1987 when I was 10, 11 years old. And that was my first intro into the business. And somehow I wound up there many years later when it was my time to start working and make some money.
Well, it's a great story. I love that. A lot of us get into it for different reasons, but yours is one of the ones that's where family influenced you. I think that's awesome. Moms have a way of influencing us in a lot of the decisions we make.
Yeah.
And you have watched this industry over her career and now your career, and you guys are interviewing a lot of people. What, in your opinion, will lending look like in 10 years? A lot of changes ahead of us.
A lot of changes ahead of us, but I do believe the core tenets of the business will stay the same. And that is people talking to people, people dealing with people. One thing that I saw my mom do when she started in the business that she is still doing today is she asks questions, she listens to the answers, and she helps people make decisions. And for all the buzz we've heard in the last couple of years about how AI is going to take over the loan officer role and we're just going to automate it, and all of the iterations of digital lending that have gone back, since 2010, 2011, DiTech, and all of the different iterations up until 2015 or 16, where it was the push button, get mortgage. We know it's more complex than that. Consumers know it's more complex than that. And so what consumers are looking for now, they're still going to want in 10 years from now, I firmly believe, in that they're going to want that guidance from a human. The difference in 10 years from today or 10 years ago is they're going to demand a better technical journey, a better digital experience where uploading documents is not tedious. You don't have to send the same bank statement 5 times because it didn't go through on the fax or it didn't come through on the lender end. I think our underwriting is going to get a lot more common sense because we're going to be able, with AI, to collate and understand so much data and really be terrific predictors of how loans are going to perform. Of course, we'll never be perfect predictors because loan performance really depends on if someone can keep a job or not. But I think we're going to get better. I mean, look at the innovation we have now with VantageScore, with trended data, and we can kind of determine with less information whether a customer is pointing north or pointing south. You couldn't do that before. Credit's always been a snapshot in time, but now we have that ability, and I think that ability to get sharper and more common sense with lending, assuming we can bring the government along with us and the regulators just a little bit. We could talk about a little comp reform if you want, but I think in 10 years we're going to be a sharper industry. We're going to have a lot of technology to support our customers. We're going to maybe make more than 16 basis points on a loan, but I still think it's going to be people helping people. I have no doubt of that.
Yeah, I think that no question, this is a relationship business. Always has been in my 52 years in this industry. I don't see that changing, but the volume of loans, how the volume flows through the old book, Pig and the Python, how it rolls through the various processes. I think that all is radically changing in the compression of time and things. But everything that most business owners, mortgage lenders that are complaining about is what it costs to originate a loan. And 60%, Mike Fratantonio at the MBA has said pretty consistently that 60% of the total cost to originate a mortgage loan is in some type of compensation paid for the origination of that mortgage loan, whether it be management all the way through down to the loan originator or the LOAs and all those involved. So what are your thoughts as far as, or do you have opinions in the interviews you've done as to what this is going to look like from a compensation standpoint?
Well, there's 2 camps here. There's the camp that says, and this is something I know the folks at Stratmore talk about, which is if you continue to index commissions to the loan amount, commissions will continue to rise, and that percentage is going to stay stagnant, and it's going to get more expensive to do loans over time. We know that the average commission has almost doubled in the last 15 years because of that. And so there's one opinion that says you need to compress commissions, and then you can find a way to profitability. Well, who wants to raise their hand and be first to do that is my question. Which lender is going to stand up and say, well, guess what? As of today, we're slashing compensation for our loan officers. You can do that. And guess what? The next day, you may have 1 or 2 loan officers left, but that'll be about it.
Forming ones in the group. Yeah.
They'll be gone. Yeah. So who wants to raise their hand first and do that? The other camp, and this is the camp that I think I have at least one foot firmly planted in, is let's find ways to manufacture loans at a more reasonable cost. Let's introduce technology and efficiencies that do that. Now, does that result in perhaps a loss of personnel? Maybe, as we right-size our companies with the introduction of technology. But the history of technology has always produced more opportunities for employment, not less. So I'm not as worried as some people in the industry that say, well, if we introduce all this tech, what happens to Sally processor and Wendy underwriter who have been with my company for 25, 30 years, I'm loath to let them go because they're like family. They've been here forever. They want to retire here, and I don't want to let them go. And I understand that. We're human beings. But maybe there's other things that they can do to help you grow market share and grow volume. And we can process loans in a more efficient way and make more money. Maybe they don't have to work as much to make as much money because the loans are more profitable. So I tend to fall on the side of let's create more efficiencies on the operations side rather than let's cut commissions. And as a former loan officer, I have a little bit of a bias towards that as well.
Yeah, of course. I can understand that. I think one of the things that as I look forward, and I'm not sure that I have any kind of crystal ball on this prophetic view, but if we can reduce the cycles and take a lot of the busy tasks out of origination, or at least the tasks that are related to the loan originators as they're doing it now, we could increase the number of loans they do in a month, therefore easing the burden to pay as much per loan. So I'm in the camp of, I really believe that loan officers are going to make more money in the future, but a lot less on each individual loan. I've got one client right now as a loan originator opening his own mortgage company that is originating 80 to 120 loans per month, consistently doing it. Now, he's got systems and processes in there. They're still somewhat archaic in my mind, but more and more of those processes get eliminated, and he condenses it down through technology, AI specifically. Then we're going to find that he is going to be able to even do more loans. And so I think one of the things that I'm predicting, and love your thoughts and reflection on, is the concept of paying less per loan, but the loan officer doing as much as 10x of what he's doing now on a monthly basis. Your thoughts?
The only pushback I would give you on that is that's a market share play, not necessarily unit play in finite terms, because there's only so many transactions that happen every year. So if your argument is going to be, we're going to take more market share because we're efficient, and that's going to allow you, the loan officer, to do more loans, and in exchange for that, I can't pay you as much, but you're going to do more volume, make more money, fine, I buy that. But that can't be a universal remedy because not everybody can do more loans just because the market is what the market is.
Yeah, I think we have a lot of those dialogues going on, and in some of the consulting work that I'm doing with different ones, it's really interesting to get the opinions on this. Let's get into talking about vertical integration for mortgage companies and real estate. Do you see more vertical integration? You work for a company, T360, outstanding company. They're focused heavily on the real estate side. So love to see what you and the team at T360 think about vertical integration.
Yeah. So I'm T360's ambassador into the lending world.
Okay,
I translate, I interpret, I come back and I explain what's going on in lending because, as you know, the lending world and the real estate world don't often speak the same language, even though we're technically married to one another, right? I mean, one cannot exist without the other, but, for as long as I've been in the business, and I'm sure for as long as you've been in the business, we've never really spoken the same language. So that's kind of my role at T3 is bridging the gap between real estate and lending. And by the way, vertical integration is one of the answers to the question you posed about how do we squeeze more juice out of the loan transaction? How do we get more profit? Well, if you're a mortgage company and you can add different platforms, if you can add servicing, if you can add a real estate company, if you can add a title insurance company or a relationship, insurance is another big one. We know that the cost of insurance is spiraling in some places out of control. If you can get a handle on that and make some revenue there, and we see all kinds of companies doing it, Rocket leading the way, their second quarter earnings outstanding, 47% attachment rate between Redfin and Rocket. Varun Krishna on the call said something that I thought was so poignant and it kind of buried the lead, but he said 70% or more than 70% of our activities now are no longer dependent on rate term refinance. And isn't that something? That we can actually be an industry that is not just sitting there praying for the rates to be cut and to get back to the low sixes, high fives. So I think vertical integration is the wave of the future. We just saw another company, Ellington Financial, that has a big reverse mortgage operation. They're getting into special servicing. They want to acquire an originator. They want to get into commercial lending as well. We've seen it with Lower and Movado. We've seen it with Guild and Bayview. It's happening everywhere. It's happening on the real estate side too. There's real estate companies, big publicly traded real estate companies that have mortgage operations that have forever either been dormant or non-profitable, and they're trying to figure out how to make them work or partner with someone that can. The customer is demanding, as I said, that the customer is demanding that tech experience that is not that cumbersome. Look, a customer gets into this deal to buy a house, and now they're in two separate journeys. They're doing due diligence on the home, and there's inspectors and appraisers, and they're dealing with the contract stuff, and then they get into this separate journey with the lender. And these things are going on in parallel. and both tend to be clunky and really cumbersome. And guess what? By the end of it, they're exasperated, they're exhausted, they never want to talk to that loan officer or that agent again. And that's why the recapture and retention rate, forget the servicing aspect, retention, recapture, you know this, about to say it's about 20% on each side. 20%, we're losing 8 out of 10 of our customers because the journey sucks. That's it.
Yeah. So true. And I haven't seen that get any better over any period of time. There's a few notable exceptions, but it's pretty rare. I've heard you talk about seamless transactions. What does that mean really to borrowers? And do they truly want a one-stop shop experience?
Sure, if you ask the average customer what a one-stop shop experience in mortgage and buying a home,
what that could be.
Yeah. Do they really know what that means? If you ask somebody if they want a one-stop shop for just about anything, they're going to probably tell you yes, right? If I told you, David, this weekend you and I are going to go look for cars, and it's a 3-part process. We've got to go look for the car. If we like the car, we have to go across the street to the bank and get a loan. If the bank says, okay, we've got to go back there, then we've got to go to the other side of the dealership and trade in our current car. You'd be like, that's not how I want to spend my Saturday afternoon. But if I told you we're going to CarMax and at the end of 2 hours, we're going to trade in our car, get a loan for the new one and drive off because it's a one-stop shop, you're going to be like, all right, let's go do it. You'll be much less inclined to say like, I got something better to do that day. So I think customers, they hear the word one-stop shop. They don't really know what it means, but it sounds better than a 5-stop shop. It sounds better than a clunky experience that is frustrating, that is tiresome. And guess what? People have a better understanding of what it takes to buy a car than to buy a home because they do it more often.
It's really interesting to bring up CarMax because I bought my last car from them and I sold it back to them when I moved from Austin, Texas to Knoxville, Tennessee here.
Great model.
I was so impressed with that whole ecosystem, and that truly is an all one-stop place. I mean, you have all the cars you could ever want to look at there, usually a good selection at affordable prices. They don't negotiate. Here's our price, take it or leave it. And then when you're done using that car, you move or life events happen, you can come back and say, I enjoyed this car, but I don't need it any longer. And they came and appraised it and wrote me a check for it. And it was the best price I could have gotten. Even better if I had to put it in the paper and had to go through all the process of showing it to people, having people buy it, then all the things, all the folderol that goes with that. I mean, I was just blown away. I'll take a little bit of a discount for the ease that has. So I think CarMax is a good one. I think our industry needs to take some lessons from a CarMax. And I think that's what
we do.
The potential with what you're doing at T360 with at least being an ambassador for that. This would be a good opportunity to tell people about T360. You're their ambassador. What are they about and what do they do?
Yeah. So, T360 is an unbelievably impressive organization, and not just because they had the wherewithal to hire me. They were impressive before that. T3 has been around since the late 90s. Our founder, Stefan Swanepoel, a pioneer in real estate, hails from South Africa, now lives in Hawaii, and, really, really brought thought leadership and critical thinking to the real estate industry that hadn't really existed before. He's now published something like 50 or 60 books. We publish multiple publications every year about the industry. We are deep dive data and research about all things residential real estate. We do a number of other things too, but we really want to be known for our data and our research and the way that we approach the business. In this era of industries coming together, it became apparent to T3 that we needed to have a little bit of a mortgage presence. And so I'm the little bit of the mortgage presence, and we're now starting to collate data and aggregate research about the mortgage industry. And right before we had this theory that vertical integration was going to become the thing of the next 5 years. And it wasn't very long after I started that Rocket announced they were buying Redfin and then Mr. Cooper, and away we went. So, I want to give us a little bit of a pat on the back for seeing that coming. And I think there's more to come. And I think that where we really help businesses is in trying to figure out, how do I integrate? One of the things that has always frustrated me, and especially as the leader of a JV at one point, I was the president of a JV, was how hard it is to create decent attachment rates between mortgage companies and real estate companies when they are wedded. And there are many reasons for it. There's technology reasons, there's cultural reasons, there's accountability reasons. But for the most part, JVs don't ever live up to expectations, neither do MSAs, and they haven't historically. The industries have been trying this in one version or another all the way back to the days when Sears could offer you a mortgage. And now we've come full circle, and now it's Bed Bath & Beyond that is potentially offering you a mortgage. So we've tried it over and over and over again. The reason that I think it can now be successful is because I think we have the technology in place to make it successful. We have the ability to route leads properly. We have the ability to track and manage data and hold people accountable for it. And the customer wants it. The customer doesn't necessarily want a one-stop shop, but what they don't want to be is harassed and harangued and bothered through the process. They don't want to get to the closing table feeling like they had their guts ripped out. And that's the reason that the retention is so bad. And that's the reason that so many relationships between loan officers and agents fail, is because you do everything right. You get an approval quickly. You get a pre-approval quickly. You may even get a final commitment pretty quickly. And then what happens between there and the closing, and there's CDs going out and the customer doesn't know how to acknowledge it, and there's tech issues. And we mess up the end product so very badly, so often. One of the coolest interviews that I ever saw was with the CEO of JetBlue when JetBlue first came on the scene. And JetBlue was not United or American. They weren't the premier level airline, but they also weren't trying to be Spirit or Southwest. They didn't want to be budget either. They wanted to focus on what's the best customer experience we can give people. And one of the things that they focused on was how quickly you got your bags after the plane landed. And what the CEO said in this interview, and I was watching it and I had no interest, I had no thought that there was anything applicable to mortgage. I was just really interested in what JetBlue was doing when they first came on the scene. And one of the things he said was the reason that getting them their bags quickly is so important to us is because that's the last experience they have with us on their journey. And I was like,
wow. That's it's amazing. Yeah. So it's a simple concept that so many airlines that have been around forever fail to really recognize, or if they recognize that they're failing on that.
And so applicable to our business.
Yeah.
So applicable. That's our closing. We screw up the closing so often.
Yeah. One of the things we're seeing is a rise on the non-QM lending in our industry. What's your thoughts as you look forward? Are you and your podcast cohorts talking about when it comes to non-QM?
Yeah, we talk about it a lot. The industry is talking about it a lot. We're going to hit about 175 billion in non-QM this year. Which again is represents
still minuscule.
It's relatively compared to 2 trillion in production overall, but it represents a huge growth number over last year. I think it's something like a 35 or 40% growth number over last year.
Yes, that is correct.
Yeah. So we're expanding our use of non-QM. At the same time, while the president's issuing executive orders to expand credit, and we're introducing new credit models like VantageScore, Fannie's quietly tightening the box on the back end. They even had an announcement in June talking about how, or maybe it was mid-July, about how there's going to be less approved eligibles coming through DU. So they're quietly tightening the screws on the back end of it because I think they're trying to clean up their balance sheet and perhaps prepare for privatization, which would be fine. But as that happens, and they've been very public about what they're doing with condos, so there's going to be a big chunk of condos, which represent 10% of our properties, that are going to have to move to non-QM. So I think overall, with tightening the box, tightening some of the guidelines, the ability to repay rules around immigration, I think we're going to start to see non-QM become a real powerful lever for the industry. And I think that loan officers are going to think about where they want to work next based on what kind of product offering that company has.
Yeah, I remember in the housing crisis, we went through that and had lower rates for a non-QM product. I mean, Nina loans that were no income, no asset loans, you could get lower rates than you could through Fannie and Freddie loans towards the end of that, the whole craziness that was going on back then. I think we're going to see more. Any hunch in your mind, estimate to what levels we're going to see the non-QM?
I think some of that is dependent on performance. One of the reasons that I don't welcome the comparisons between non-QM and subprime is because non-QM, there's real-time data being analyzed and there's adjustments being made to how it's underwritten and processed. So I think as we see how these loans perform, you're going to see the private labels open up or shut down some of the spigot on these loans. And I think the growth is really dependent on how measured we are in terms of underwriting and how good we are and how these loans perform in the market. So I have high hopes for it. I have a strong cautionary prognosis for lenders, which is ignore non-QM at your peril, because it's going to become a much more important lever as we continue to go forth. It represents, 8% of the market now. I see no reason why it can't get to 15% in the next couple of years, especially with Fannie doing what they're doing. So, I think people need to plan for it.
Let's shift over to talking about credit scoring, credit bureaus. What is your perspective on the competition in credit scoring and the credit bureaus? What does that mean, and how does it relate to the overlays where you see the GSEs?
Yeah, well, first of all, I'm happy we finally have some competition in credit scoring. I'm curious, the data has started to come out. We've had, I think, less than 5,000 loans that have actually run through the VantageScore pilot with PennyMac and UW and Rocket.
Who still owns it? Do we really have we really created competition, or is it a very controlled competition?
Yeah, I would agree with you. It's definitely more on the controlled competition because it is owned by the bureaus, but it's something. And I do like the fact that there's trended data now. I do like that FICO 10T has now been released. So at the very least, if we don't see any relief on pricing, but we see some competition in terms of innovation and data and how the scores are compiled. I think that's good for us. I think the bureaus certainly have a stranglehold on the data side of it, and they like to convince people that there's no way you could operate with just one of us or just two of us. You need all three to get a holistic picture of the borrower. I don't see any relief coming there, although I know the industry every couple of months gets all riled up about it. But, I think really what we need to get to, look, Fannie and Freddie, they don't underwrite using a score. They underwrite using data. They have 200 different data points in their algorithm that help them make a decision. So can we get to a point where we can eliminate or introduce some competition in the three bureaus and eliminate scoring altogether? I would love to see that because I think that's where it should naturally go.
Yeah. Great commentary. How can people learn more about your podcast? Tell me about, which ones are you on? The Friday one is the one that really caught my attention recently.
Yeah. Friday, I'm on with Crispin Commentary's Last Word, and that's Fridays at 10 a.m. Pacific. I'm on the West Coast, so I give things in Pacific time.
Good people.
And that's with Brian View, Kevin Pranio, and Christy Sukumnut. And then Thursdays, my newer show, we're 13 episodes in. It's called No Surrender with Greg Sharon, Aaron D. And that's Thursdays at 10 a.m. Pacific. And, I love being on both shows, and they both have very different dynamics and energies to them. And I love the co-hosts that I have. They're close friends and confidants, and I feel very lucky and grateful to be on the air with them.
Good people. And I love the fact that you're bringing in fresh perspective, and we can't have enough perspectives on it. We're looking at navigating the waters ahead. And that's where at a multitude of counselors, you wage war, and this can feel like war. And the counselors that we are is sometimes electronically podcasting, putting out thoughts, reflections. Kudos to you, Coby, what you're doing. And again, T360, very impressed with this company. How can people learn more about T360?
You can go to our website. You can follow me on LinkedIn. There's links to T360's work and a lot of the stuff we do on my LinkedIn page, and or just get in touch with me. I'm not hard to find.
Yeah, that's really good. What's the last question is, what are the trends that you are following and you and your cohorts are following on the podcast? Where are you saying, man, we got to get focused more on? What would that topic be?
I think we're very highly focused right now on consolidation in the mortgage business. Everybody kind of laid off everybody they could lay off back in 2022. We had, 40%.
Unless they consolidate.
Yeah. So consolidation is the next wave. We're seeing it happen in little mini waves. We're not seeing huge deals like the real estate brokerage side is seeing, where you have, the Remaxes and Real combining, or you have Compass and Anywhere. But we are seeing smaller deals happen. Envoy and ASIN-MAC is one of them. NewRez sending their distributed retail to American Pacific and Synergy One.
I think certainly the wave of consolidation is going to continue in both the real estate that you guys focus on at T360, as well as the mortgage industry. I think more and more, how can someone survive unless they're really small and really agile? And then how can someone survive unless they're up over $3 billion a year in production and going up? The guys in between are going to get squeezed in many, many ways. Great. So good to have you here, Coby. I appreciate you for joining me, and it's fun learning more about T360. I have a tremendous respect for Jack and Stefan, and looking forward to getting to know them better. Back in my old hometown, Austin, Texas.
That's right, Austin, Texas, yeah.
It's good to be with you, Coby. Thank you so much for joining us.
Thank you, David. Good to see you.
Folks, I hope you enjoyed this interview with Coby. I enjoyed it. It's fun to get to know more and more people in this industry who are becoming increasing voices in our industry. And it's Coby and certainly Greg Scher and Aaron D. and Christy, all providing great commentary and great perspective. This podcast was made possible because of our sponsors, First Close, Titleese, Angel AI, which we talk about in this podcast, as well as True, as well as Candid, Mortgage Bankers Association of America, Lenders One, Modex, as well as Redder, Mortgage Advisory Tools, and Fuel Inc. Folks, appreciate you tuning in on another one of our podcasts. Share it with others, and look forward to seeing you back here next week.
You've been listening to Lykken on Lending. Our passion is to bring you the latest insights, trends, and updates from the world of mortgages. So on this show, if you're a seasoned industry veteran or just getting started, it's your go-to source for all things mortgage. We hope you've enjoyed the show. We'll be back soon. Take care, and we'll see you next time on Lykken on Lending.